Hey everyone, welcome to the module of core concepts. We'll be talking about some basic things that you really need to know and some basic strategies. And this may be a reiteration or expansion of some of the things you may have previously heard in the module, but let's just go ahead and start. So first off, let's remind ourselves, what is the stock market? So in short, the stock market is a marketplace where buyers and sellers trade ownership in companies. These exchanges are always highly regulated, where there are only publicly traded companies, so companies that have already gone through the process to make all their books and accounting and processes clean in order to display their financial and operational performance to the public every quarter. So companies can only become public through an IPO, which is short for an initial public offering, where you can think of it as a professional roadshow to the public world that a company is going to become publicly traded, opening their equity, opening their shares to be sold to the public marketplace, and pretty much showing to the world what they're about and what their financials are like. Going through an IPO is not the only way that a company can go onto a stock exchange. It can also be done via direct listing. The only difference between a direct listing and an IPO is that a direct listing doesn't have, let's say, the roadshow or public presentation that an IPO does, where an IPO presents themselves also mainly to institutional investors, so that before they go onto the public marketplace, that they already have institutional investors. So these are like big funds or big investment banks, big, large, high net worth investors to invest in the particular company before it goes live, so that there's a little bit more of a price benchmark. So yeah, but you don't really need to understand the difference. That's roughly how companies get onto the public market. And there are 21 major stock exchanges in the world. So this is defined as stock exchanges with over $1 trillion worth of shares being traded. And some of the most famous ones to know are things such as the New York Stock Exchange, the Nasdaq, the Euronext, the Japan Exchange Group, Hong Kong Stock Exchange, London Stock Exchange. These are all examples of major stock exchanges in the world. And what the stock markets really allow is pretty much to allow individuals to buy and sell in a regulated auction. So an auction where there's bids for buying a share at a particular price or different prices, and say same for selling. So it works in a bid format. Now, just to explain it again, what does it mean to be done at an auction or a bid format? It pretty much says that you put in an order or a bid to buy a stock at a certain price. And if there is a seller that is willing to sell the stock at that particular price, you get to buy it immediately at auction over the exchange. Now, let's remind ourselves, what is a stock? So a stock is a little slice of a company, let's say. So it's a share of ownership of a company. And these units of stock are therefore called shares. And companies create stock, so they issue and create additional stock to raise funds to invest in their business. And that's why they enter the public stock market, to raise these funds from public investors like us. And when you buy a slice of stock, so a share of ownership, your share of ownership entitles you to that share of profits. So let's say if I were to buy myself so many stocks that I would own 0.5% of a company, I'll be entitled to 0.5% of their profits. And you can sell that share of ownership at a price that a buyer is willing to pay, as defined in the stock market. So let's say if I want to sell a stock at a particular price, let's say the current market price is $120, I can sell it at that price and someone will buy it at that price. Now, what is an index fund? Index fund is a type of ETF, so exchange traded fund. And why is it an exchange traded fund? Is because it is made up of assets that are publicly traded on exchanges in the public markets. And the only difference between normal ETFs and an index fund is an index fund is specifically a low-cost, non-actively managed fund, which means that the distribution isn't really changing actively or isn't following a certain strategy. An index fund just broadly tracks a particular market. So it's pretty much built to automatically match a group of stocks in the market. And it's considered ideal for risk management, as we'll explain earlier in this module, as it pretty much broadens the investment across everything in the market. So it's as broad as it can be for that particular market. So if certain companies fail completely, that's completely fine. It's built to expect that. But since it's completely distributed, it catches the performance of the really good companies. And then overall, you get the net appreciation of the market as a whole. So you track that particular market. Therefore, it's great for risk management. Some famous index funds that you may have heard of are things such as the S&P 5, the Vanguard's Total Stock Market Index Fund, the Vanguard Total International Stock Index Fund. You'll see here the word Vanguard a lot. Vanguard is the name of one of the biggest asset managers in the world. And Vanguard or BlackRock, BlackRock's iShares, these are basically the names of the asset managers that create these index funds to track particular markets. So they'll often have their name associated on it because it's managed by them. And the S&P 500 is the top 500 companies in the US stock market. So a great investment option for anyone, in my opinion. And here you can see the examples of their actual 5-year performance as of the date of 30th April 2024. So the last 5 years, what their average annual return is. For the S&P, it's 11.3%. For the Vanguard Stock Market Index Fund, it's 14%. For the Total International Stock Index Fund, it's 7%. So there are slight differences according to each index fund, according to what market they're tracking. And obviously, you can never use how they've done previously to accurately predict how they will progress in the future. But it can give you an idea of how things gone in the past, what the overall averages are. And since we want to follow a very low effort, low stress investing strategy, my opinion is to just invest into whatever market you feel comfortable with and then just sort of leave it there and let time take care of it itself. So how is money made with buy and hold investing? So there are mainly two ways. So one is appreciation and the other is dividends. So appreciation, what is it? It's the rise in the share price, where when you buy a particular thing, you want to sell higher than what you bought for. Obviously, this is not guaranteed. The price can go up or down. And this is obviously very risky when it comes to buying individual stocks. But when it comes to if you're buying a certain index fund and you expect it to appreciate over the long term, you tend to then sell it later or sell parts of it later as it accumulates and you want to withdraw from your investments. So you make money by selling it at the higher price. So for example, if I buy $100 of S&P 500 today, and in 20 years, it's now 13 times the price. So instead of $100, it's $1,300. I can sell at that particular price. Or if I want to sell all of it, I would make a profit of $1,200 since I'm taking advantage of the rise in the share price. So the appreciation. So I took advantage of that. Now, the second thing is dividends. So this depends on the company's preferences and is usually paid out quarterly. But what dividends are what we talked about before, your share of the profits of the company. So some companies, this is not common with tech companies because tech companies usually want to take their internal profits to fund for future expansion and future growth. But many companies, such as Coca-Cola, it's a very common dividend stock. These are stocks of companies that pay out profits to their shareholders. So it's not just a question about the price of the stock, but also how much are they paying out to you annually, or in some cases quarterly. And this is a form of recurring income. So for some people, they focus on buying stocks or index funds that are dividend focused and it's getting paid regularly from the company profits. And you can also make money on the same stock or the same index fund via both appreciation and dividends. So you can make money from the dividends that you receive from it and still sell it later on at a higher price. You can make money via both methods on the same index fund. But in general, dividend stocks tend to grow slower. What is the reason for this? Is because when a company pays out profits, that pretty much the profit is now into your pocket and is not associated with the stock or is not part of the company anymore. Whereas if they don't pay out profits and they just invest it into themselves, therefore they expand the company, they expand the value of the company, and that typically makes the share price rise higher as they become more valuable, since they're pretty much withholding that profit for now to invest to have the company become more valuable. All right. And when it comes to buy and hold investing, you generally hold your positions or your index funds for many months or often years in buy and hold investing. As mentioned, we always want to invest for the long term, as that's where the real big compounding effects will start to take place. And that's where the majority of our money will be made. I mean, just to give you an example, Warren Buffett, if he stopped investing at 65, none of us would ever know of him. Over 95% of his profits or 90% of his net worth gain came after the age of 65. So really letting time take its hold is the magic of buy and hold investing. So how money is made with trading. So let's talk about this, even though we don't recommend it, just so that you understand how money is made with trading. So trading typically involves doing multiple transactions during the day or week of pretty much going long. So as mentioned before, long is actually buying something to hold for yourself, and you want to, as mentioned before, buy low and sell high for a profit. So buying at $100 and selling at $110 for $10 profit. And the opposite, going short. So pre-selling high and buying back low for profit. So quick succession trading can come in the form of day trading, high frequency trading, swing trading, scalping, forex trading, momentum trading, technical trading, and more. So there are different versions of trading that follow different styles and strategies, but they're all typically fast paced. And trading is definitely not recommended for most. And most people who aren't professionals actually lose money on this. So we have explained this in the first module, some stats behind this. And we'll explain a little bit more why so many people try to popularize trading and get you to start trading as well. You'll see a lot of people on Instagram, on social media, trying to promote trading courses and try to get you to start. This is not something that we recommend. And let's talk a little bit here. What is better for us, buy and hold investing or trading? So if we look at an article from the Motley Fool, some of you may know as a huge financial news and financial advice newsletter slash magazine slash website. And they have an interesting article, and you'll find similar articles across the web that compare long-term investing versus day trading. And here we'll just look at some quotes from them where they picked out certain studies where, for example, here the study revealed that the people who traded the most earned an annual return of 11.4% compared to the market's return of 7.9%. The study's conclusion does not mince words. Our central message is that trading is hazardous to your wealth. Another study on the fate of day traders in Brazil found a mind-blowing 97% of individuals who persisted with day trading for more than 300 days actually lost money in the long run. So the reason for this is because trying to time the market with trading is typically way more stressful and worse performing than the lazy method of going time in the market instead. Is because when you try to time the market, which means, try to buy at the perfect time, try to sell at the perfect time, and try to do it quickly, is that it's very prone to mistakes, emotional stress, and in the end, you will not be perfect at your trading strategy. And people literally take decades to learn and perfect this. Obviously, there are going to be some people, the top 1 percentile, that manage to get the hang of this and go with really advanced, complex strategies and are able to do this and who actually make money. But for everyone else, it doesn't make money. So you can pretty much compare this to sort of winning the lottery. It's great when you hit the jackpot, but for most, you're just going to be losing your money in the long run. And we highly recommend that you do not partake in active trading. And in the end, the ones that do trade the most, they still underperform just the general market. So you may as well just spare yourself the hundreds or thousands of hours of stress and losing your money, and instead just do buy and hold investing and spend time in the market rather than trying to time the market. Now, contract for differences, CFD. What is it? So we'll explain this more in a later video, but just for you to quickly know what it is. Contract for differences, CFD, is a financial arrangement where an investor and a CFD broker, often in cases the trading app that you use is a CFD broker themselves. That's how most trading apps or investing apps are set up, where a CFD broker agrees to pay the price difference of a financial product from when the contract opens to when it closes. CFD investors, which in this case are us, don't own the asset, but they profit from its price changes. Benefits of CFDs include lower cost access to assets, straightforward execution, and the flexibility to go long or short. So that's the reason why most trading apps or investing apps use CFDs, because it's pretty much simpler and easier. But a key disadvantage is that the initial loss equal to the spread size when entering a CFD. So that's basically the trade-off, that the spread or the gap between what the current lowest buy bid is and what the highest sell bid is. This is a spread. This is typically a little bit larger when it comes to CFDs, as the broker tries to sort of manage its buying and purchasing for you in its own way. And that's usually what causes the key disadvantage of spread size with CFDs. But other risks involve minimal regulation, possible liquidity issues, and the necessity to sustain sufficient margin. We'll explain all of this a lot more in the later video, but just want to give you a bit of a heads up now. Just know that most of your investing in brokerage apps will use CFDs. We'll explain this more later. So, rules to follow. So, as we know the basics now, and we've talked about some of the basics in the previous videos, one thing that you should always be aware of is that you should only invest in what you understand. If you ever invest in a particular stock or a particular group of stocks that are very narrow, only invest with facts, not emotions. Only invest if you have a proper strong thesis. Elsewise, try to just go broad. So that's why we highly recommend index fund investing. You don't need to be a finance guru to understand it, and you don't need to have so much stress over it. The only thing you need to understand there is to understand that you want to invest for the long term, and it's best to just set up an automatic investing plan and then just don't check your investments in order to not let emotions or panic affect you. For most people, therefore, index funds and broad ETFs are the best. And if you see an opportunity, then you can take it. Most people just stay stuck in analysis. And as we know from our first introduction video, the character of Ashley Action, people who take action earlier often then benefit the most, as they just have more time in the market. So if you see an opportunity, just take it. If you see something's overly undervalued for no reason, just take it. But fundamental analysis and understanding and analyzing a particular stock is something that goes beyond the range of this course, and I think beyond the scope of time and effort for most people that are watching this course. So in the end, that's why we recommend just investing in index funds. In the end, you will be actually outperforming most professional investors. So, some people may do amazing 80%, 200% gains on a particular stock, but in order to make some very good trades, you ultimately have to make some bad trades. It's just the law of numbers. There's going to be ups, there's going to be downs. Therefore, you may as well just save yourself the time and effort and human error and emotion and just invest in broad index funds and ETFs. So, value versus growth investing. So yeah, let's talk a little bit about this. This is advanced, but I just want to highlight this just so that you know a little bit what it is. These are two very common and acceptable advanced strategies for investing. So value investors, you can think about famous ones such as Warren Buffett. They basically do a fundamental analysis of companies. What does this mean? They look at the company's financials, try to estimate their value using financial equations, and comparing versus other companies that are similar and what price they're trading at. And they're pretty much looking to buy companies that are undervalued by the market. So if the market, for some reason, believes that there's a sentiment against this particular company, but the financials itself are pretty strong and there's a strong outlook for the future, value investors buy these undervalued or fair price companies and then sell it when they become overvalued. So this is mainly done by advanced financial institutions and financial investors. And this is the concept behind value investing. So trying to find the underrated value and investing in it and selling it later on. And then there's growth investors who, instead of looking at financial fundamentals of a company, of a mature company, like let's say Coca-Cola, growth investors instead look to the potential and growth of the company. So often these types of companies are either fast growing and sometimes have not yet made profits. So tech companies are very common for this, where they look for the potential and growth of a company, where fundamental analysis matters less. So ignoring common financial ratios or terms such as PE ratio, so price to earnings ratio, so price of the stock versus the actual earnings generated by the company, and other sort of typical things that will be used for mature companies. And therefore, investments tend to be a little bit more riskier, but higher growth, as a lot of it is not determined by actual money coming out of the company. It's often still things that are highly changing and fastly growing, and therefore is usually in emerging industries like tech, like Google or Tesla, or things that are a little bit more highly volatile and fast moving. And therefore, as a result, investors don't care that much about the balance sheet. Balance sheet, for those of you who don't know, is basically a documentation of the assets and liabilities of the company, and therefore also the debt that the company has. For a lot of growth investors, debt is okay. But yeah, that's basically the idea behind growth investing. And when you're a little bit further advanced along, way beyond the scope of this course, maybe later on down the line, maybe in a year or two, if you start to get really interested in, we recommend combining both. when you're feeling a lot more confident about a company or a particular set of companies, if you have a particular thesis or understanding of a particular market. But starting out, again, as always, stick to passive methods like index funds and ETF investing, as this will, in the end, outperform the most, and it is so easy to maintain. So this is a popular question that a lot of us ask, and you may ask yourself, how much should you invest? We'll go into this in a little bit more detail in, I believe, module 4, when we're talking about the habit of investing and how to set yourself up. But we'll just talk about a little bit about it now already. So first off, always invest in your education first. So a lot of people think that with a low income amount, you can already pretty much start saving and investing to become a millionaire or even beyond. That's not going to get you to a millionaire. First, you need to set yourself up with income generating skills if you haven't reached that state yet, to best set yourself up in order to be able to invest. So if you're earning only $1,000 a month, investing into the stock market isn't what's going to get you wealthy and rich. What you need to do is invest in your education first. Some people go to university, some people take a course, some people do a coding boot camp, whatever it is, to get yourself and your income generation up high first. This is obviously your priority. This is going to be the foundation for your investing, because if you can get that up and developed, you can then start to really set a lot more money aside to invest in yourself and really build that foundation for the long term. But you need strong income generation before you start investing. You can start investing a little bit when you're in the very early stages, but the thing that's really going to move your future investment pile later down the road is making sure that right now you get yourself to a point where you're investing into your education, to your skill set, so that you generate a lot of future income that you can start investing in. Okay, so moving on. First off, make sure you don't invest the money that you need to live, please. Everyone needs to afford basic necessities, so don't preemptively invest money that you need for rent, for food, for basic utilities. Obviously, look over your budget. What do you need as necessities? To understand how much money you can actually put aside automatically that you can afford to just invest. And also, of course, make sure you don't invest if you have any expensive debt. So, I mean, there's no point investing for a 9%, 10%, 12% annual return if you have debt that is costing you 15, 20% annually in interest. So if you have any debt, pay that down first. For a lot of people, if you have very low interest debt, so if you have debt that you're carrying at 1-2%, then it actually makes financial sense to invest instead, because if the return of what you generate is larger than the interest expense of the debt, then it's actually a net gain. Actually, this idea is something that's used a lot in private equity, using debt to invest into things that generate a larger return. But as a retail person, as an individual, you're almost never going to get such low, cheap debt. So if you have any debt, it's most likely that you just want to pay it down first rather than investing. But this is, of course, dependent on the interest that you are paying down. So make sure you're also, as mentioned, making an effort to raise your income. So this is how the rich get richer. It's mainly primarily raising the income. That's the definition of getting rich. Rich is based on your income. Getting wealthy is then the result of being rich and being able to invest on the side. But again, if you can afford the basic necessities, then you can start to really invest and build that wealth in the long term. Now, excess cash. If you have excess cash in the bank, a lot of people wonder, hey, should I only start investing small amounts from future paychecks that are coming in from today onwards? That's fine. But if you already have excess cash that is just sort of sitting in the bank, you have, like when I first started investing, if I had just 10,000 in my bank account, I'm not going to let it sit there and just contribute an additional 400 euros or 500 euros or 1,000 euros every month. Only I may as well just take that excess cash that I have, if I don't need it for any immediate expenses or whatever, just take that and invest it. That's a lot of capital. There's a lot of compound interest that you're missing out on. So you may as well just take excess cash and invest it. And as will have explained in the very first video, starting as early as possible to build the habit. Start now to build the habit and get on the right path. Even starting with small amounts, 100 euros, 200 euros, 400 euros, 500 euros, even just small amounts of just building the habit helps immensely. Of building the habit so that as your income continues to increase, as you're investing in yourself as well and developing your career, your job, your business, whatever it is, you already have the habit set aside of saying to yourself, hey, I'm going to invest 10% of my income, 15% of my income, 20% of my income. That automatic plan is already set up, so that often when people want to invest larger amounts, it takes a little bit of time to think about, okay, do I want to invest larger amounts? But if you already have something set up that you're already investing without even thinking about it, 10%, 15% of your net income, it's very easy to then just go into the plan and just adjust the amount that you want to have automatically invested. So just building this habit and starting early on, the more time you allow yourself, the more time you take advantage of, the earlier you start, the more compound interest has time to really grow, and it grows exponentially. So there are a couple calculation examples that you see a lot from famous YouTubers that's being trendy right now, that they always say that the first 100,000 in net worth is very difficult to achieve, but then after that it becomes way easier, because if it takes you 7 years to get to the first 100,000 based on your investing plan, it then takes you 4 years to get to the next 100,000. So going from 100,000 to 200,000, and then each incremental amount, it takes less and less time to achieve it. So the longer you let it just sit there and build and compound over itself, so the earlier start, the better it is for you. So set an automatic monthly contribution goal to invest based on all the above. We'll go into this a little bit more detail, and I think module 4, when we talk about the habit of investing and how much you should be setting aside, what percentage amount, and also what it means to change your percentage amounts from 10% to 20% to 35% to 50%, how it affects your investing speed, the time horizon, how long it takes to achieve certain goals. So setting that monthly amount and making sure that it's automatic. We want this to be completely brain dead, stupid, simple. And as a beginner, prioritize index funds and potentially copy trading. So we'll explain this more later. And where copy trading is basically copying the trades and portfolios of a particular person. So this is something that some brokerage apps like eToro offer, and is very popular. It basically allows you to take advantage of an active trader or investor without having to do the due diligence of the particular stocks or companies that they invest in yourself. It pretty much outsources the investing work to someone else. But obviously, we would prioritize index funds because it's a lot stronger, a lot better for risk management, and is the brain dead way that outperforms most professionals. And of course, avoid, please, margin trading, as this can result, instead of getting a 12% return or whatever, you then wipe out your entire money if you get on a margin call, which we'll explain in a later module when we talk about CFDs. But you just want to avoid this kind of active high volume trading, and also shorting stocks. As we will have explained, hopefully in the first video, shorting is something a little bit more advanced. It can leave you very exposed and is generally just not a good idea for the long-term investing. Generally, things tend to go up in price. And since we're investing in index funds, you're betting on the market, and the markets tend to grow over time. Okay, due diligence. Of course, before you make any investing decision, before you make changes to your portfolio, always do your own research before investing. So we recommend at least 1 hour of specific research in any asset that you invest in minimum, even if it's an index fund. Usually when you want to invest in index funds, you want to compare versus other index funds. Think about, okay, what's the geographies that I want to be investing in? How do I feel about the future political or economic outlook for that particular region? Or if you're investing in a particular ETF that follows a particular sector, how do I feel about the search engine sector, companies like Google, Microsoft with their Bing, etc.? Or do I want to invest in automotive companies or ESG focused companies, so environmentally focused companies? If that's what you believe in and what you think that's going to be the trend moving forward. Whatever it is that you're going to be investing in, spend time researching it. Look at the historical performance, look at your personal future outlook for it. Obviously, the more safer the investment is, like broad index funds, the less specific research you'll need. But if you do anything that is more like a technology sector ETF, or if it's a specific stock, definitely do a lot of research beforehand. Individual stock picks are very risky, and we do not recommend going beyond 10%, definitely not 10%, but even beyond 5% when you do a particular stock pick. But yeah, you can skip this at your own discretion when it comes to copy trading, since you're basically outsourcing the decision to someone else. But of course, you should still do research on that particular investor or trader that you're copy trading from to understand, okay, this type of person, do I agree with in terms of investing style, investing risk, the types of companies that they're investing in. But what you skip for the due diligence with them is the specific company and purchase decisions that they make, because this is something that they're basically doing for you. They're doing the due diligence for you, and that's why copy trading is so useful. But above all, know your risk profile that you're comfortable with. So if you want to stay low risk, if you're close to retirement, let's say, and you want to play it super safe, low risk things such as bonds, it's a low return, low yield, but it's super safe. Bonds, treasury stocks. And then if you want to go a little bit more risky, but it's still completely healthy, index funds, ETFs. And if you want to go super high risky, if you really want to go balls out, then you can do individual stock picks. Let's say I want to invest solely in Apple or Tesla or any big stock that I'm a fan of. Of course, potential big upside, potential big downside is a huge risk. We would prioritize index funds. It's the brain dead method. It's the method that only requires up to 3 hours in a year to maintain. Ideally, when it comes to investing, you don't want to think about it. You want to take the tried and tested method that outperforms most actively managed funds and just let it grow by itself. And finally, of course, know your timeline. Always think long term. Think about starting early and thinking about the long term effects of compounding. As we explained in the first video, or maybe in a different video later in this course, when it comes to calculations of, what does 9% mean over a certain number of years, after I think 25 years, it was a 13 times growth of your investment. So letting it grow longer gives you a much better exponential growth. So always think long term. When you want to buy and hold something, think about always the long term. If you stick to short term mindsets when it comes to more active trading, like within a day, within a week, there's so much volatility. There's so much you can't account for. Even just holding it for just a few months, it's very, very volatile. It's not something that's reliable that you want to go for. You want to go for long term things. Think about Warren Buffett. Think about all the great large investors that do buy and hold investing. It's simple, it's emotionally light. If you constantly think about short-term holds, then you're constantly going to be looking at the market and go, oh, the market took a 5% dip today. Should I sell? This is where people lose their money, or they lose out on major gains. Things will be volatile in the short term, but you need to think long term. If you exit in a moment of panic in the short term, you're basically saying goodbye to money in the long term. Things pick up and grow over the long term. That's why we promote index funds. Unless an entire country market is going to completely collapse, even when it has collapsed previously in global financial crises, in the dot-com bubble, when the housing market crashed in 2008, or even after that, when Brexit happened and Trump got elected, there was a lot of uncertainty. There's so much crisis that affects things in the short term, where sometimes it's a 5% dip, it's a 10% dip, or if it's a huge crisis, even a 20-30% dip. But in the long run, it's always picked up. So always think long term and don't give into short term panic. We want to keep it automatic, we want to keep it simple, and we want to think long term. All right, I think that's it. This was the last slide, and see you in the next one. Enjoy.